because they want to make money. They want to be able to convert it into more dollars in the future. And that's really not what they're for. It's like taking all of your disposable income and buying extra insurance on the value of your house in the hope, in case it gets struck by lightning. I mean, you own enough physical precious metal that it can be your insurance policy against all this craziness. Some of the top performing stock markets ever have been in hyperinflationary environments. You just got to make sure that your investments keep up with inflation so you're not constantly losing purchasing power. So the metals have a role in that type of portfolio.
Gold is on the verge of a breakout from a 3-year consolidation. Previous similar breakout occurred following a multi-year consolidation in May of 2019, which resulted in 50% rally within 14 months. The coming rally could propel gold to $3,000 mark in even a shorter period of time. Craig Hemke, a prominent financial commentator and the mind behind TF Metals Report, shares his insights during the interview. According to Craig Hemke, restoring confidence requires reverting to hard assets like gold when a currency loses public trust. The US dollar now accounts for 58% of foreign exchange reserves held by overseas central banks, a record low. Gold, the most ancient widely accepted international currency, has chipped away at some of the dollar's dominance, accounting for 15% of reserves, up from 11% 5 years ago. Hemke suggests BRICS countries may create new currencies to reduce reliance on the US dollar while stressing the importance of gold backing for confidence. For years, leaders of BRICS countries have discussed a framework for a shared currency, with proponents arguing that it would protect against devaluation when the dollar rises. However, experts point out that structural challenges in BRICS countries, including a lack of robust central banks and monetary policies, make it infeasible. Meanwhile, Craig Hemke believes that daily gold price fluctuations might not be all that important when considering long-term events. Now, we present the clips of Craig Hemke's insights from his recent interview with Liberty and Finance. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
The only way, ultimately, after everyone loses confidence in your currency, the only way you can regain that confidence is to go all the way back to the beginning and back it with some type of hard asset like gold. I mean, that's what happened at the end of World War II. That's why the dollar became the world's reserve currency, because if you're going to rebuild the world, you can't have France, issuing francs and Germany issuing marks and England issuing pounds, and because no one's going to have any faith in it. So we'll have the dollar be the reserve currency. Everybody can trade in that, and the dollar be backed by gold, and you can swap it out for $35 to an ounce of gold anytime you want. And that gives the whole world confidence to you have this currency that you can use in exchange, and here comes your global economy. Well, eventually that's what's going to happen. That's why all this talk, a couple months ago about, remember all that stuff about the BRICS rolling out some kind of currency? They'll eventually do that, one, as an alternative to the dollar, so they're not prisoner to the dollar system. But you can't just roll out some currency and say it's backed with other fiat currencies like the current from the IMF. You're going to back it with something, to give it kind of a competitive advantage, to give you some confidence in it. So anyway, wrapping this all back to the individual, that's what the gold and silver does for the individual as well. I mean, you can, again, read in this book about the people that were able to get their hands on gold back in the 1920s in Germany. And that allowed them, that was their vessel, to keep using your ship in a storm metaphor. That was their vessel that got them through. I don't know, too many people over the last decade have seen this coming and have dropped everything and said, I'm just going 100% in the metals, thinking that was, because they want to make money. They want to be able to convert it into more dollars in the future. That's really not what they're for. It's like taking all of your disposable income and buying extra insurance on the value of your house in the hope, in case it gets struck by lightning. I mean, you own enough physical precious metal that it can be your insurance policy against all this craziness. We can talk about gold in a second, but you sit back and you go, does it really matter? I watch gold go up and down, $100 here, goes back up $200 there, $15 a day and stuff. And that's fun and it's interesting, but does it really matter in the grand scheme of things? If you figure, how this is all going to play out over the next few years, and I guess really it probably doesn't.
Craig Hemke expresses concern about banking problems related to the Fed's actions, especially regarding interest rate fluctuations. Higher rates, of course, fed the balance sheet woes that flummoxed the regional banking industry this spring. Unrealized investment losses tied to rising rates led to the demise of 3 lenders, slicing a third of the value off the KBW Regional Bank Index between early March and mid-May. Furthermore, Hemke's belief is at the end of the debt-based Keynesian system, posing a long-term challenge to the current fiat monetary system. Since there is no limit to the amount of fiat money in circulation, it is subject to constant manipulation by the central bank and the government. This can lead to inflation, interest rate manipulation, and other issues. Let's get back to the interview.
I still don't think that the banking issue is over. The Fed rolled out this near-term or whatever they call term funding facility to allow banks to essentially put undervalued securities to them and get them back, get par back to shore up their balance sheets. That has left the impression that problem has been papered over. But if you dig deeper, there are a number of banks, particularly Bank of America, that are dealing with all sorts of balance sheet issues because of the investments that they bought when interest rates were 1% are now, they'll mature at par if it's, a bond or a treasury or something. But that's at some day in the future. Now they're priced at 80 cents on the dollar because interest rates moved up so much. And so if you're using that as the stable part of your balance sheet, all of a sudden your debt to your reserves is thrown out of whack and in some cases insolvent. That's what happened to Silicon Valley Bank and some of the others. So I don't think that problem has gone away, obviously, because interest rates have continued to climb from where they were last fall or back in March. So that's obviously an issue. The overriding issue right now as we record this is the events in the Middle East, because nobody knows what's going to happen there. And if that evolves into a wider conflict that involves Iran specifically, who knows what's going to happen, say, to the price of oil and liquidity flows around the world. That is a major, it's like the anvil dropping on Wile E. Coyote. It's like hanging over our heads, and you just hope it stops and doesn't smash down on everybody. So that's obviously a really, really big concern. But, as I look at it, though, it's the same thing that you and I have discussed as long as we've known each other. It's the reason why I started my site 13 years ago. And it's what we call the end of the great Keynesian experiment. Keynes being this kind of Depression era, 1940s era economist. I guess we'll charge him with the idea that you could have a debt-based monetary system and that can produce prosperity. Well, you can't argue that in many regards it did. The problem is the end of that system wraps up with this exponential amount of interest that needs to be paid to service existing debt, and you've got to grow your economy and grow your money supply fast enough that you can continue to service that debt. And the whole thing just begins to spiral out of control, where like you see on the U.S. debt chart, it's $1 trillion and it takes a year and a half to get to $2 trillion, and the thing just begins to go parabolic. And that's the overriding thing, because that, maybe the war resolves itself peacefully and maybe the Fed starts cutting rates and the banks aren't as stressed as they would appear. But this accumulated debt and the amount of cash that has to be utilized and created to just simply service that debt, just to make the interest payments, exacerbates the annual deficits, and the thing just begins to just rapidly spiral out of control. And that math is really a certainty. And so we can talk about, the anvil, like I said, we can talk about, maybe the war, is avoided and all this kind of stuff. But the math of the end of the great Keynesian experiment is, that just is what it is. So that remains the biggest problem for us, for our kids, our grandkids, and everybody else that, lives under this fiat system.
The future of gold is promising, as it is on the cusp of breaking out from a 3-year consolidation. Analysts note that with gold prices trading at their highest levels since early August, there is not much stopping the market from pushing back to $2,000 an ounce. How can individuals and nations safeguard their financial futures during these changing tides? Share your thoughts in the comment section below. If you find this video informative, don't forget to show your support towards our channel and turn on notifications to stay informed about our latest videos. See you in the next video.